When most of us think about taxes, we just think about money leaving our pockets, right? It feels like a burden. But what if that's the completely wrong way to look at it? What if the tax code isn't just a rule book, but more like a playbook? Today, we're going to deconstruct the US tax code, not as something to be feared, but as a system packed with powerful incentives, a blueprint really, for building serious wealth if you just know how to read it.
So here's our game plan. We've broken this down into a 5-part framework to walk you through it. We'll start with the why, the whole philosophy behind the code. Then we'll dive into the nitty-gritty, the actual mechanisms investors use to slash their tax bills, shield their assets, and ultimately pass that wealth down the line.
All right, first things first, the tax incentive engine. You really have to get this part because it's the foundation for everything else that follows. See, the tax code isn't just about collecting revenue. It's a powerful tool the government uses to encourage us to do very specific things with our money. Which of course leads to the big question, right? Why does it feel like the system is kind of stacked in favor of investors and business owners? Well, the answer is actually pretty simple. The government wants to motivate regular people to do things it doesn't want to do itself, like provide housing or create jobs. And what's the motivation? Tax breaks. That's the carry. And you can see the difference so clearly here. As an employee, your income gets taxed right away and you just don't have that many direct deductions. But for an investor or a business owner, it's a completely different universe with a whole menu of deductions. And listen, this isn't some accident or a loophole. It is a calculated reward for taking the financial risks that help fuel the economy. Okay, so now that we've got the why down, let's get into the how. This brings us to our second section, engineering paper losses. And this is where we dive into one of the most powerful and honestly one of the most misunderstood tools in the entire tax code, depreciation. So what on earth is depreciation? Let's keep it simple. It's a tax deduction that lets an investor write off the cost of a building. Now, not the land, just the structure itself over a set period. For residential real estate, the IRS says that's 27.5 years. It's treated like a business expense, even though you don't actually write a check for it every year. And this is where things get really interesting, what we call the depreciation paradox. Think about this for a second. The tax code lets you claim that your asset is losing value on paper, while in the real world, that exact same property is very likely going up in value. It's a non-cash expense that creates a very real tax deduction. And that simple idea is a huge part of what separates savvy investors from everyone else. And the financial impact here is just massive. As experts in the space always point out, this one single mechanism allows you to generate cash flow from rent and benefit from real-world appreciation, all while telling the IRS you had a loss on paper. It's a total trifecta for building wealth. But wait, it gets even better. You can actually put this strategy on steroids. Instead of taking that slow, standard deduction over decades, investors can use a strategy called a cost segregation study. Basically, this just separates out parts of the property, like the carpets or the appliances, that have a shorter lifespan in the eyes of the IRS. This lets you write them off way faster, pulling huge deductions into the first few years of owning the property. Okay, so you've just engineered this massive paper loss. Now what? Well, that brings us to section 3, how to unlock those losses to offset your other income. But there's a pretty big hurdle to clear, and this is where most people get stopped dead in their tracks. The reason they get stuck is because of this regulatory wall called the Passive Activity Loss Rules, or PALs. In short, the IRS says you can only use passive losses, like those from a typical rental property, to offset other passive income. Your salary from your job, your W-2 income, that's considered active income, and it's protected behind that wall. But there's a powerful bypass, a sort of secret door in that wall. And that door is the short-term rental. The tax code treats these completely differently. If your average guest stays for 7 days or less, and you materially participate in the business, meaning you're actively managing it, not just a silent partner, then the activity is no longer considered passive. And just like that, the wall crumbles. And those big paper losses can directly offset your main income from your job. So now that we've figured out how to generate and use these tax savings, we need to protect the assets themselves. This brings us to Section 4, the Strategic Liability Shield. And the best shield for the job is the Limited Liability Company, or LLC.
An LLC really serves two main purposes. First and foremost, it's a firewall. It creates a legal separation between your business stuff and your personal stuff. So if someone sues the business, your personal home and savings are safe. It's also a great strategic tool for privacy and for building business credit. But, and this is a huge warning, if you start mixing your personal and business money, you can pierce the corporate veil, and that protection can just disappear.
So, the order you do things in is absolutely crucial here. You must establish the LLC before you buy the property. You buy the asset in the LLC's name from day one. That gives you the maximum privacy and legal protection. If you try to transfer it into an LLC later, it can get really complex and might even trigger a clause in your mortgage that makes the whole loan due immediately. And now for the end game. This is the final piece of the wealth building puzzle, the one that plays out over a lifetime. Section 5 is all about erasing generational tax bills with a powerful concept called stepped-up basis. Stepped-up basis is one of the most powerful and yet least known provisions in the entire tax code. The easiest way to think about it is like a giant tax reset button. When an heir inherits an asset, the IRS essentially forgets the original purchase price and resets its cost basis to whatever it's worth on the date of death. Let's walk through a quick example, based on some expert analysis to see just how profound this is. Imagine an investor buys a property for, say, $300,000. Now, fast forward a few decades. Through smart management and a good market, that property appreciates like crazy. At the time they pass away, it's now worth $6 million. That's a $5.7 million gain. So how much capital gains tax does the heir owe on that $5.7 million of growth? The answer is zero. Nothing. The cost basis gets stepped up to $6 million. The entire lifetime of appreciation is passed on completely tax-free. This is the core mechanism for preserving and transferring wealth across generations. Which leaves us with one final thought. After seeing how all these pieces fit together, how depreciation creates paper losses, how short-term rentals unlock them against your income, how an LLC protects your assets, and how stepped-up basis can erase the final tax bill entirely, you have to ask yourself, is the tax code just a list of rules to obey, or is it a system of incentives that's just waiting to be mastered?